Now it's time to turn our attention to our second interpretive technique, divergences. In the description of overbought and oversold conditions, we assumed that the oscillator peaks and troughs at approximately the same time as the price, but in reality, momentum just as often turns ahead of it. Prices in financial markets usually reach their maximum level of momentum ahead of the final peak in prices. In this example, both price and momentum peak at point A. If the price makes a new high, which is confirmed by the momentum index, no indication of technical weakness arises. But on the other hand, if momentum fails to confirm a new price high, as at B, a negative divergence is set up between the two series, and a warning of a weakening technical structure is given. Such discrepancies normally indicate that the price will undergo a corrective process. It can take the form of either a sideways or horizontal trading range, or more likely, a downward one. However, the price will sometimes continue upward to a third top, and be accompanied by even greater weakness in the momentum index, as happened at point C. Occasionally, the third peak in the momentum index may be higher than the second, but lower than the first. Either circumstance requires some degree of caution, since this characteristic is a distinct warning of a sharp reversal in price or a long corrective period. Here's one of my homemade cartoons. It shows a car traveling along a road at the end of a field. Now we can't hear the car, but we can see that it's moving along quite nicely. And based on this observation, we should expect it to finish its journey quite comfortably. However, if we were on the other end of the field and could actually hear the engine, we might observe a clanking noise that would suggest some serious trouble. And it's the same with markets. We could watch a price trend like this one. It's moving higher, and since we're long, that's good. But under the surface, our momentum indicator is not doing so well, for the price is rising as the momentum is gradually getting weaker and weaker. But how do we know the price will not continue to make more gains? We don't. That's why divergences must be confirmed by some kind of price reversal signal. It's only when the price becomes responsive to what the momentum is doing that we get an actionable signal. After all, what starts out as a single divergence could end up with multiple divergences. Confirmation can come from any legitimate source. My favorite is trendline breaks, but it could be a price pattern completion or a moving average crossover, and so forth. So back to our divergences, all three of them. Note that it's possible to construct a trend line for the price, and when it's violated, the divergences are confirmed. It's extremely important to note that divergences only warn of weakening or strengthening market conditions, and don't represent actual buy and sell signals. Whenever any divergence between momentum and price occurs, it's essential to wait for a confirmation from the price itself that its trend has also been reversed. This form of insurance is well worth taking, since it's not unknown for security prices to continually lose and regain momentum without suffering a break in trend during a long, persistent advance. In a sense, it's possible to equate negative momentum divergences and price trend breaks with dark clouds and rain. If you look up at the sky and observe dark clouds, common sense tells you it's probably going to rain. But you don't know for sure until you can actually hold out your hand and feel the rain on it. In other words, the clouds, like the divergences, warn of the deteriorating weather. That's the technical condition. But the change in weather is signaled only by the first raindrop, which is the confirmation by the price. It's possible to take the analogy a step further by concluding that the darker the clouds, the heavier the rainstorm will be. Taken to its logical market conclusion, as a general rule, the greater the number of negative divergences, the weaker the underlying structure. Here's a weekly chart of the Russell 2000 index, together with a 13-week rate of change. Here's a peak, and here's a negative divergence. We can go all the way to number 7 and see a host of negative divergences. You can even see a marginal new high at 8, and an even lower momentum peak. It was even possible to construct a trend line that connected all these peaks. There were a large number of divergences, so it's not surprising that there was a huge decline that followed. And that was the 2007-2008 bear market as it happened. Divergences also appear at market bottoms, where they're called positive divergences because momentum bottoms ahead of price. In this diagram, the price makes a series of lower lows at A, B, and C. Momentum, on the other hand, is rising, or what we call walking uphill. This is a positive divergence because at point C, downside momentum has greatly dissipated. So even though the price is still falling, it's doing so at a slower pace. Let's look at another analogy. Again, please excuse the cartoon. This time our car is driving down a hill in neutral gear. Here we see it gathering up a little bit of speed, but it's not until after this point that it will really pick up steam because the slope is sharper. Now if we're looking at a speedometer, this will be the point of maximum downside velocity. So here we go. After that, the car is still moving until it comes to a final stop. After the sharp drop, the speedometer indicates lower and lower velocity, but the car is still making lower lows, so to speak. In this example of the sugar price, we see the 10-day rate of change walking uphill or diverging positively with the price. It's also possible to put in a downtrend line, and we know that when the line is penetrated, that the price will confirm the divergences. And that's exactly what happened. Not the greatest of rallies, I'll grant you, but certainly a nice buy signal.